The following is a paid commercial program. Unless otherwise identified, the guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of Global News Radio 640 Toronto.
Good morning and welcome to Your Life, Your Money right here on Global News Radio 640 Toronto. I am Chris Chreston and I'm joined as always by Kelvin, the money guy. Who's Kelvin, the money guy? Well, he's only one of the top financial advisors in the country, and really nice guy and a great guy to know. And we're glad to have him here to help you navigate your money life as well as you can, and plan for your retirement, plan for your kids' education, plan for your next vacation, maybe just plan for the new TV that you want to buy or something like that. Whatever your money needs are, your money life is, Kelvin is the guy to know, and he really breaks things down in a way that makes it simple and easy to understand, which is always important when you're dealing with a world of finances that we all pretend we understand, but we don't necessarily understand the finer points on it. And Kelvin takes out all of the needless details and breaks down those acronyms so that you can understand and you can navigate your money life better. If you've got a financial advisor and you want a second opinion, or maybe you don't have a financial advisor and you're thinking, well, maybe I should get someone to check out this stuff that I've been doing on my own here. Well, Kelvin's the guy to talk to too. askkelvin.ca is his website. That's askkelvin.ca, and you can call him anytime. 416-457-7526. That's 416-457-PLAN. And hey, I've been bigging the guy up. I've been talking him up, and here he is, Kelvin, the money guy. How you doing today, Kelvin?
Hey, Chris. Good morning. How are you?
Good. It's it's another summer Sunday here. We're getting through here, hoping to get my everything ironed out in my move into when my babies are born soon. Yeah. So I got a lot happening. If there's strange noises, it's because I've got a painter somewhere in the house, somewhere lurking and beautifying my house and doing a great job actually. Yeah. But it's all these things that you do in your life, especially right now surrounding my move, surrounding the kids coming. The bills keep on coming. Like I've had Visa check up on me. Like, are you sure this is you making these ridiculous purchases? What are you doing? Do you have the ability to pay this back? And that's something that I'm sure a lot of people are worried about in their lives, and the expenses they have, and whether it is a move, it's adding members to your family, or if you're just sort of going about your life and going about your family life and trying to figure out how to make ends meet. There's a lot of different challenges, and I think a lot of people can relate to some of those things. And one of the things that we keep hearing about when it comes to finances, and we keep seeing headlines about, and we're kind of like, yeah, I know what that is. I kind of know, is inflation. And the truth is, most of us don't really know, especially people of a younger generation, don't necessarily have the experience with inflation. And those of us and those of the listeners out there who do know about inflation, do have experience with it. It was so long ago that they had to face real inflationary problems. Right. That they don't really remember what it is. And I think that that's a perfect topic that you brought forward for us today, is inflation. And, you keep hearing about it. What is inflation really, Kelvin? And why is it rearing its ugly head right now?
Yeah, so inflation could be a big risk to the stock markets. And of course, all of us, I guess, have money invested in the stock market, either through RSPs, TFSAs, pensions, things like that. So inflation, we hadn't had to deal with for about at least a decade or so. So what is inflation? Well, I have clients that tell me they've paid more for the last car than they did for the first house. So think about that for a second. A car back in 1985 cost $6,200. In 1990, that same car cost $15,472. And the average car today in 2021 is $30,000. So that's inflation.
That's huge. That is a big difference, all within my lifetime.
Yeah. What it cost us in 1970 for people that are in their 60s, no, whatever you bought, whatever it cost you 25 cents for, today it's about $1.65. So that is inflation. Inflation is losing the purchasing power of your money. So when you invest, we didn't have, like I said, we didn't have to deal with this till about, well, now, the last time was about 10, 12 years ago. So typically when we have inflation coming through, meaning the government's going to have to raise interest rates. And when the interest rates go up, there's a ripple effect in the stock markets. So it could possibly cause a sell-off as much as 10 to 15%. So we need to prepare now for that kind of stuff. Think about this for a second. A microwave in 1990 was $99. The same microwave today is $183. So that's so true with inflation about our dollar, what happens. So I'll talk during the hour about some other little things that we like our cars and our houses and TVs, what it cost back then versus now, and what will it be in 10 years from now.
Right.
So that's why we as investors have to prepare ourselves not to worry about it, but as the economy gets stronger, we rebound from the pandemic, that will trigger inflation, requiring investors to rethink their portfolio and make adjustments to make sure that we don't suffer these great losses as we get older. So inflation would typically benefit things like raw material initially. And, we've seen a lot of movement in energy. Look at gas, where it is today. Gas is $1.37. Last year, I think it was like 80 something cents, or maybe that was the first year of the pandemic. So we look at copper, we look at corn, we look at all that kind of stuff. It's all gone up in price. If you've been to the grocery lately or Costco, usually you walk out of Costco with $500, $800, maybe $500 to $800 of stuff. When you go into Costco today, you're walking out with the same bill, but not as much of stuff. And those are the little things that are telling us that inflation is creeping up. Things are getting expensive. So we need to prepare for that. Think of lumber.
That's a huge one.
Yeah. Lumber in 2020 was $3.50 for a 2x4. It's gone up 323%, or $15 for that same 2x4. So anybody that's doing construction and thing around their house have noticed that, first of all, they can't find the lumber. And if they do find it, it's gone so much up in price that we don't know if it's worth it to do the work anymore. So those are some of the things that we see that's going to be coming within the next 6 months to a year. So we have enough time to prepare, for that kind of stuff. And like we always say on these shows, you really need to plan for whatever comes in the future. Sit down with your advisor and go through some of the numbers, go through some of the things where your money is invested, and don't panic, but be prepared. So if you plan, you won't panic, right? So,
Yeah, I think I'm reminded of a meme where I saw it was stressed about a task. The best solution is complete that task. And that's really what it comes down to is, if you've got a plan, you're not going to be as stressed about it because it's the unknown that's stressing us out. So when it comes to inflation, there's the obvious things that'll sort of fire off on you when you're thinking about lumber. The initial thing is, can I afford to build a new fence? I've been spending more time at home and spending more time in the backyard, and so is my neighbor, and I'm tired of looking at him tan in his Speedo. But so you've got to make that decision. Can I afford to build that new fence? Can I afford to build that new deck? And also the other cost is the cost of housing, and the cost of anything that's being constructed with wood is now going to go up as a result of that too. And then you've got to make that decision. And then it spins off into your portfolio as well. So you've got to make sure that your portfolio is prepared for that, because that's your retirement savings, that's your long-term savings, and you've got to make sure that you're prepared on that end, because it's not just affecting your ability to see or not see your neighbor in a Speedo, it's also affecting your ability to retire comfortably.
Yeah, so the question is, how do we prepare? And what should we do? And typically I always say to people, just do the opposite of what you're thinking.
Take the Costanza approach.
Yeah.
This show brought to you by Vandalay Industries.
I mean, before you get into that, look at two key things that's going to drive the stock markets to come. It's going to be the bond markets and what the Federal Reserve does between now and the year end. So that is going to prepare us for 2022. So, I've been calling all my clients. This is the week I started calling. I can't believe we're in the middle of August already, eh?
Mm-hmm. I know.
So I've been calling all my clients, and the last time I spoke to them was about 3 months ago. But when I call them, they say, Calvin, I haven't heard from a while. But it just seemed from March to now, been such a long time. It's unbelievable, So it just goes to show, over the next 3 to 6 months, we really need to sit down and put pen to paper and figure out where we want to go. So after the break, we'll maybe continue about how to prepare and what should we do.
And that's coming up with Kelvin, the money guy. How to prepare for a future with more inflation coming up, how that's going to affect your retirement savings, how that's going to affect your portfolio, how it's going to affect your life. Inflation is something that a lot of us haven't had to deal with in quite some time. So getting a refresher on it with Kelvin, the money guy, is very important. Don't forget, you can always visit his website, askkelvin.ca. That's askkelvin.ca. And you can call him anytime, 416-457-7526. That's 416-457-PLAN. More with Kelvin the Money Guy, talking inflation here on Your Life, Your Money on Global News Radio, 640 Toronto.
You are listening to a paid commercial program. Unless otherwise identified, the guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of Global News Radio 640 Toronto.
And welcome back to Your Life, Your Money here on Global News Radio 640 Toronto. Don't forget, you can reach out to Kelvin anytime at 416-457-7526. That's 416-457-PLAN. And visit his website, askkelvin.ca. That's askkelvin.ca for more content, more information, and also you can reach out to Kelvin on that website. Again, that's askkelvin.ca. And this hour we're talking about inflation. We're seeing a lot of headlines about inflation, thinking about that coming up and thinking about how you can prepare for it to make sure, it's going to affect your life, but how do you prepare for it to make sure that it doesn't negatively affect your portfolio and your retirement savings? That is why Kelvin, the Money Guy, is here today to talk to us about inflation. So picking up from where we left off, Kelvin, how can we start to prepare for this as we anticipate it coming?
So I think what we have to consider first is how to position the probable sell-off that might be coming because of the rise in bond yields and the Federal Reserve tightening. Some of the key things that we have to remember is why these things are happening. Like, why are they doing this stuff in the first place? And what does history tell us and how stocks behave when these things happen? I mean, it's happened before. It's like it's nothing new, right? It's just we don't remember, right? So the consensus view is that tapering and rising bond yields, will kill off economic growth and stop the bull market in the stocks, right? Mm-hmm. But that isn't actually true. It's the opposite. Initially, tightening will cause stocks to fall or just go sideways, right, at best, right? And people think, oh my God, everything's crashing. I better sell everything and move it, just like we did 19 months ago when the pandemic first happened, mm-hmm. right? But, stocks shake it off and they move higher and the bull market continues, you have to go lower before you go higher, right? It has to go backwards before it goes forward. And it's what you do in those backwards or when it goes down matters when the recovery happens. All of this stuff makes sense because what's happening is tightening is a good reason that helps companies. So what it does is it pushes earnings a lot lower, a lot higher, and it resets valuations lower. So what that means is when the valuation of companies go down, so it makes it more attractive for investors to buy. So tapering is part and parcel of a recovery. It's response to successful policies and rebound in the economy. That's a natural part of a bull market. And it allows the stock markets to go a lot higher. So really, these tightening and bond yields going up is actually healthy for the economy and healthy for our portfolios.
Interesting.
Yeah, it's like I say, it's really the opposite of how we have to think. Think of when things are cheap, we buy. When things are expensive, we don't buy. So maybe think of it that way. And when you look through all the markets, fireworks that may happen ahead, because of economic growth that will push some of the earnings down and things like that. We really need to sit and figure out, what happened back in 1990, 1991, 92, when inflation really raised its head back then. And some of those things is what we have to use the past to help us to push forward, especially with the stock markets, So the next leg of the bull markets will start once we see a drop in the market. So we might see a 10, 15% drop. That will tell us we're ready for the next leg of this bull market. Like I said before in some of the past shows, some of the things that the money people see in the 90s is still similar to this decade. With the change in the pandemic really changed the way the way we're going to do things in the future. So it's a good time to sit back and reevaluate what you do, get prepared we know that inflation is coming, so it's not like we don't know. We know interest rates are going to go up for sure. When it happens, we don't know, but we need to get ready for it. So it's like sports, it's like, football will be starting soon. So it's like, have like a game plan. So I got like a 5-point game plan to help people get through what we're going to see and get ready for the next, 5-10 years of our money life. So good things are ahead. It all depends on what we do.
And it's just like in sports, it's important to have someone on your bench who's got some experience. And, if you were around when there was a lot of inflation in the past, maybe you weren't invested in the same way. You may be looking at retirement now when you were, just in the workforce back then. Kelvin has been advising people and been in this industry for almost 30 years. 30 years? It's been 3 decades of Kelvin. And so he can learn from other people's mistakes. He can learn from the past, and he can bring that knowledge to your game plan. So Coach Kelvin now has a plan to help you move forward, and that's part of all the financial things we talk about is having a plan, and that's why it's part of his phone number, 416-457-PLAN. That's 416-457-7526. So Kelvin, let's dig into that 5-point game plan that you're talking about, because I think a lot of people, like in so many things, I always say there's so many people who are just sort of like, I get it. I think I get it. I don't really get it. So I'm just going to not do anything and hopefully everything goes okay. Or those same people wind up panicking the minute that things start changing and start pulling their money out. So it's important to have a plan so that you can make little tweaks along the road and you don't wind up messing up the whole game, and you can keep moving down the field. If I'm still using this analogy on football properly, hopefully I am, we'll have a good game plan. Kelvin, let's dig into that 5-point plan.
So the first one is, do not get defensive, meaning that when there's turbulence in the stock markets, our knee-jerk reactions to do what? Sell, go into stability stuff, or defensive. names like utilities and consumer staples because, we still have to eat and things like that. And if you look at the reports as because of the pandemic, what happened, it shot food prices way up, right?
Right.
And companies that like Loblaws and so on, stocks have gone way out of whack. But doing that stuff would be a mistake because you want to go, you want to don't be defensive when the economy is slowing or contracting. You want to do the opposite, right? One of the problems is that defensive stocks, or when you got into different yields and so on, such like bonds, they get really hit hard when interest rates starts rising. So when interest rates go up, bonds are not going to do very well. So you want to maybe look for more dividend producing stuff inside of your portfolio, dividend paid stocks and bonds. So the best way to protect, I find, after all these years of doing this, to protect yourself is to tie your portfolio to the overheated economy. That's where you're going to benefit more, profit from the growth and profit from and leverage into those type of stocks. So you don't need to get defensive. What I find is get your emotions away from your money.
Right.
And I think that's one of the reasons I find where people need a financial advisor, because we don't have any emotions attached to your money. We're an outsider looking in. So we kind of scare you away from those emotional decisions when it comes to your money.
And it's hard not to get your emotions involved in your money, especially when you're managing it yourself and you're kind of, freaked out. You get overly excited and you put too much money behind something that you're really into, or you get overly panicked because you see things starting to move or decline or change, and you pull everything out. And that's why it's important to have an objective person on your side and someone who's been able to look at the entire field of play. And if I'm back to my football analogy, a good coach has some tricks up their sleeve, and I think that having a good coach like Kelvin, the money guy, in your corner is always great. askkelvin.ca is his website. That's askkelvin.ca. Now, you're talking about this 5-point plan, Kelvin. You're talking about being objective about it and having someone in your corner to help you out. Like there's a this might be a good moment to talk a little bit about sort of the general better results that you do get when you have a financial advisor on your side.
So studies have shown that when you use an independent financial advisor, you typically get about a 3% rate of return higher. And I think that's because we really don't get too emotional. We don't really, sell and buy and switch things and do all these funny things that people want to do when they manage their money themselves. And I think that's the big thing. Think about this. The Dow Jones year to date is up 15%. The TSX is up 17%, and the S&P is up about 17%. So that tells us that, we might see a market correction coming down the road, right? So we should expect it. If we expect it and it happens, it's okay. If we don't expect it and it happens, we're panicking, shocked, and oh my God, I'm going to lose all my money. When I look at last year, return in the Dow was about 28%, which is quite high. The TSX 24 and the S&P was 32. So those returns are really, really high, which is good for us. So the second thing I find is, go with companies that benefit from growth.
Right.
We know that, when I quoted those returns, we've had rapid economic growth, right? So it's getting out of hand. So the governments have to tighten things. So they got to taper stuff. They got to cool the growth, not kill it off, but knock it down by tightening things and making it a little bit tougher for people. Stocks linked to growth typically are the best place to be, which means that cyclical things like industrials and consumer names and small caps and things like that will be slower in growth. So adjust your portfolio, look at what you have inside. I always talk about this. Don't just look at your return. Look at what's inside of your portfolio. Open up that statement and look at the third page or second page and see, what am I investing in? Am I prepared for, if there's a turn down, am I prepared for it? Am I ready for it? So those are some of the things that you want to look at. And that will help you, when you look back in a year, 3-5 years from now, you'll go, man, I made some of the right decisions. So, inflation, like we say, is coming. We know it. We know interest rates. It's been all over the news, all over the world. It's coming. We know, because we got to pay back the debt. So be prepared for it and embrace it, because it's happening. Right?
Yeah. And we look at the way that governments are spending these days, or in the last year and a half, and we see that there's a lot of debt. There's a lot. And it's going to take a long time to pay a lot of this off. So going forward, there's going to need to be some belt tightening. So that doesn't mean it necessarily has to be a terrible thing for your investments. You just have to make the right plans to make sure that you benefit from them moving forward. And that's what we've been talking about here, especially regarding inflation, with Kelvin, the money guy, and rolling through some of his 5-point plan. We're through step 1, which was do not get defensive. The step 2, go with companies that benefit from growth. And if you want to go back and listen to this show, we always post the past shows up so you can share it with your family and friends, and you can say, listen, this is what this guy Kelvin has to say. And you can always reach out to Kelvin if you've got any questions as well. His phone number is 416-457-7526. That's 416-457-PLAN. And don't forget to visit the website, askkelvin.ca. That's askkelvin.ca. Rolling through with the rest of Kelvin's 5-point plan to get you through the inflationary period that is coming up right here on Global News Radio 640 Toronto.
You are listening to a paid commercial program. Unless otherwise identified, the guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of Global News Radio 640 Toronto.
And welcome back to Your Life, Your Money right here on Global News Radio 640 Toronto. I am Chris Chreston, joined as always by Kelvin, the money guy. He's one of the top financial advisors in the country, and you've got him right here all to yourself. askkelvin.ca is his website. That's askkelvin.ca, and you can call him anytime. 416-457-7526. That's 416-457-PLAN, and that's a cell phone number, 416-457-7526. And this hour we've been talking about inflation, and I think it's probably a good time to sort of reset a little bit and remind people a little bit about what inflation is and why we're expecting it to increase in the near future.
So it's been a long time since we have to worry about inflation, because of the strong economic growth, because of the pandemic. We're getting back, everybody's getting vaccine and things are starting to open up again. So it's going to trigger prices to go up and interest rates to go up. So it means bond yields are going to go down. So it means you got to adjust your portfolio to take advantage and embrace the changes that are happening. So inflation, like I said, I have clients that tell me they paid more for their last car than they did for the first house. Cable, like we all have cable, right? I mean, we all have 999 channels and we only watch 3, right? So cable back in 1990 was $9.96 a month. The average cable bill today is $116.
Wow.
So it went from $10 to $100 and almost $120.
And it's amazing to think that at the time when cable came out, it was sort of seen as a bit of a luxury thing. It's like, they have cable. They're only paying $9 a month for it. And now we're paying $100 a month on average. And it's something that's sort of seen as almost average. And that's on top of all the other things we're spending money on for our entertainment, on streaming services and whatnot.
When we were growing up, we didn't have cable. So I grew up in Montreal, and there was cable there, but we couldn't afford it. So we had an antenna.
Yeah.
and you would turn a little thing on top of your TV and spin the antenna. And we picked up Burlington Channel and anyhow, but yeah, you're right. And then now we all have cable, right?
Now we all have it. So we find a way to pay for these things, and that's part of having a good financial plan. But it's amazing to see that inflation and how much it's something that was relatively cheap back then is now very expensive.
Well, back then, 1990, a Sony 27-inch TV, and remember Sony back then was all that, right?
Mm-hmm.
It was $1,550 for a 27-inch Sony TV.
Wow.
And look at the high-end TVs today. They go for like, 10, 20 grand, right?
Right. You buying your 8K, big screen. Yeah.
4K, all that kind of stuff, right? So inflation, what it cost you something to buy in 2000, what it cost you $1, today's $1.65. So that's the power of inflation. So when those things happen and interest rates go up, there's stocks that perform very well when those things are happening. So the third thing in our 5-point game plan is do not get out of stocks. Okay, that's our first thing to do. If you think a sell-off is coming, it might be tempting to try and get out of stocks right before that, and then to buy back after the weakness happens. But this is a lot harder than people think. In fact, I think it's almost impossible to time the market. So the trick is, it's not timing the market, it's time in the markets. So prepare yourself for these things, readjust your portfolio, and you'll be fine. You have to make two smart decisions. You have to if you want to time the markets, you have to get out just before the correction. You have to decide when to get back in. And I don't know of too many people that can do that consistently.
I think, like you said, it's almost impossible. It's like trying to time jumping from sprinting through a revolving door and try and jump into another revolving door. Like it seems to me to be almost impossible.
And that's how you get yourself in trouble. And that's what happens. You get a bad taste in your mouth for stocks and investments, and it'll just take away from, how you're going to prepare for your time and so on. So don't get out of stocks. Don't try and time the markets because you can't. Remember, it's time in the markets, not timing the market, and you'll be fine. So people have to think back to the beginning of the pandemic in March, last year, when stocks fell almost 50%. If you hang on and you spoke to your advisor and you put some common sense, you'd be rewarded. Like I say, last year, the Dow was up 28%. So if you had sold back in April of, the pandemic year, you'd have lost a lot of money. You'd never make it back up.
Yeah, well, I'm sure a lot of people probably, reacting emotionally, reacting sort of out of fear of seeing the markets going down, pulled out and said, I'm going to ride out this pandemic. I'll hold on to my savings in something more secure or something like cash, and then wind up seeing now the buying power of that cash depreciating with inflation.
And that's why it's important to have an independent financial advisor, because we take away those emotions from you and put common sense. We've lost our common sense, eh?
I was just saying this actually to my wife. I said, I don't know if it's something to do with the pandemic, but we've sort of lost our common sense, or we've lost our ability to properly manage and judge risk and assess the risk in our own life. Yeah. And it feels like we've in so many different ways, if it's even going to a shopping mall or investing, somehow we've lost common sense.
We did, and like you say, risk. Risk is how you determine risk. Risk for you, Chris, is probably not the same for me and for anybody else, right? And remember, there's always a risk in not taking a risk,
right? But
the risk has to be calculated. So you've got to do things, like I said, don't be defensive. Go with companies that benefit from growth, because it is happening. In fact, there's a fundamental shift in the way we're investing money. The investor now wants stocks that are friendly to the environment.
Mm-hmm.
They want that recycling stuff. We want all these stuff now. So what's happening is the stock markets are actually changing with the new companies that they're putting in and getting rid of some of the old ones like Enron and so on. They're getting, Tesla. The companies are going to be good for the economy, but yet make lots of money for themselves and for the investor.
And then good for the environment and good for sort of whatever the thing is that people are thinking in the back of their mind, or investing sort of with their heart a little bit as well. And that's always an opportunity when there's a new kid on the block to get in on something like that.
Well, think of the last 3 weeks when you look at the news of the weather, fires burning everywhere, man. Look how hot it's been out in BC and even here, right? So is climate change coming? I guess. So that's why you're finding now there's a change. And then after the break, we'll finish up with the last couple of the 5 game plan.
Yeah, as we continue the game plan on how to prepare yourself for inflation coming up here on Your Life, Your Money. I should give you the number, 416-457-7526. That's the number to call Kelvin anytime. That's 416-457-PLAN. And you can visit his website, askkelvin.ca. That's askkelvin.ca. Stay tuned to hear the rest of Kelvin's game plan on Global News Radio 640 Toronto.
You are listening to a paid commercial program. Unless otherwise identified, the guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of Global News Radio 640 Toronto.
And welcome back to Your Life, Your Money right here on Global News Radio 640 Toronto. askkelvin.ca is the website. That's askkelvin.ca. And you can call them anytime. 416-457-7526. That's 416-457-PLAN. We've been rolling through Kelvin's game plan on how to prepare for inflation. And Kelvin, we started out with do not get too defensive, go with companies that benefit from growth, do not get out of stocks, always important. That was where we sort of left off, was don't time the market. Don't try and time the market. You can use your financial advisor to help you navigate the waters, but don't try and jump in and jump out. It's not going to end well for you. And Kelvin, let's continue talking about inflation.
Yeah, so we know when inflation comes, we know interest rates are going to go up, right? So the fourth thing we want to do in this 5-point game plan is don't own bonds. Because when rates go up, bonds will go down. The bond yields will be about 2% or higher by the year end, they think, right? So you don't want to own bonds when prices fall because the yields will rise. So unless you plan to hold the bond to maturity, which could be 5 to 10 years, to collect income, you're not going to do very well. Remember, inflation will head to about 2% now, maybe 2.1. I'm not sure. So if you're getting a 2% yield on your bond, well, guess how much money you're making? Nothing. Yeah. And what if inflation goes to 2.7 or even 3%? Then what? Well, you're actually losing the potential, the buying power of your money. And really, that's what inflation is. Inflation is really losing the purchasing power of your dollar. Like I said before at the beginning of the show, what cost you 25 cents in 1970, for people that remember, cost you $1.65 today. So that's the kind of thing that happens. So, we need to prepare for some of the things that are going to be coming up within the next year and a half, and it's not going to happen overnight. So you got lots of time to prepare. The fifth thing I find is go with financials. When strong economies happen again, because the tightening is going to slow things down, but then it's going to come back up and with a vengeance. So look for financials like bank stocks, things like that, because banks have to borrow. Since banks borrow money at the short end and they lend it in the long end, steeping up the curves will help them make money. Remember, the banks borrow money at 2% and lend it to us at 4%. Mm-hmm. Didn't you wish you owned a bank?
Yeah.
Right? So we know when the economy gets strong again, banks release reserves and they lower provisions for loans and things like that. Right now, you remember about, I think maybe 6 months ago, the Bank of Canada, they're tightening up the way we borrow money for homes, and we have to go through the stress tests and whatnot. Right. It's because they want to slow everything down because it's getting out of hand, right? Remember, the average price of a house in Canada, not here in Ontario, because it's crazy, but in Canada, in 1990, the average price of a house was $80,000. In 2000, it was $120,000. And in 2010, it was $222,000. And today, 2021, $716,000. That's across Canada, right? Not just here. So you see what's happening when prices are getting out of hand, the banks have to step in and cool things down. Once they satisfy that they cool things down, well, guess what happens? The opposite happens. So now they make it easier for us to go and borrow money and things like that. So if you go with financials, eventually, things are going to get back to normal and they're going to make all kinds of money. Remember, the banks make $1 billion every quarter, right? And how do they do that? Well, they borrow money at a lower rate and lend it to us at a higher rate to make all kinds of money. So I think those are the things that you want to sit back and think about over the next little while. You don't have to rush into doing things, but I think we need to sit down and have a plan for where we want to get to.
Yeah, find a way to inflation-proof your investments and get yourself into a better path forward, assuming that there is going to be some inflation going forward. And you know what? If you've got a plan, then you're going to be prepared. If you don't have a plan, then you're likely going to panic.
Right. And we know inflation is coming. We know it's going to be a big risk to the stock markets. We've been through it before. It happened before. It's nothing new. So how to prepare for it, right? One thing I say is do the opposite of what you should do is probably the opposite of what you're thinking. You need to sit back and have a plan for yourself of where you want to get to. And I say it's that 5-point game plan that we've been talking about. Don't get too defensive about your money. Get into companies that benefit from growth. Do not get out of the stock markets for sure. Don't do that one. Don't own stocks that have bonds. I don't own any bonds, I should say, and go with financials. And if you do these things methodically, you'll be prepared for the downturn and you'll be prepared for the next leg of the bull market. Things need to get backwards before it goes forward. It's like, you got to take a step backwards before you take a step forward. Same thing with the markets.
Well, Kelvin, that's all the time we have for today. Thank you so much. I learned a lot. I hope our listeners learned a lot as well. And if you've got any questions for Kelvin, don't forget you can call him anytime, 416-457-7526. That's 416-457-PLAN, or visit his website, askkelvin.ca. That's askkelvin.ca. And you can book a complimentary appointment there at askkelvin.ca. That's askkelvin.ca.
The preceding was a paid commercial program. Unless otherwise identified, the guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of Global News Radio 640 Toronto.